I know that when you're doing a mortgage, oftentimes you have to go to the person that's gonna lend money, the company that's gonna
Yeah.
lend the money to you, and say, "These are my assets, these are my liabilities."
Mhm.
And then they're gonna qualify you, "Okay, you do qualify for a mortgage with us as the
Mhm.
lender." One of the things that I found really interesting is that different lenders will qualify you for different terms and different policies and different amounts
Oh, yeah.
with exactly the same numbers. Could you talk about that?
Yeah, so different lenders have different criteria, right? So, uh, look, the day of everybody kind of fitting in the box perfectly has been long gone for probably like the last 15 years. Um, I find the majority of transactions, doesn't matter if you're high net worth or if you're a first time buyer, if you have great credit or if you have bruised credit, everybody has a little bit of an exception required to make the deal work. And that's really where the magic happens. All the lenders work in that environment where it's like, hey, we're almost here. There's something just a little bit outside the box. How do we mitigate that to justify the loan now? The thing is, when you're looking at that, each lender has different criteria. Some lenders will lend a lot less because they're not looking at your true capacity. You're not looking at your true net liquidity,
Mm,
and they're just looking at the income that you file in your T4. And if you're self-employed, you're probably not filing 100% of your income in your personal tax because you're
yeah,
self-employed, so you can avoid paying a ton of tax, right?
yeah, yeah.
So in that case there, Bank A might say, hey, I'm going to give you whatever, let's say $1 million. Bank B says, well, you got $3 million of liquidity. I can actually take that into consideration. And now, plus your income, I'm going to give you a loan of up to $2 million.
Mhm.
And they're both big five banks,
Yeah, yeah.
just slightly different policy. And the policy will change at time depending on the bank's tolerance and their risk and their own balance sheet. So as a broker, we have to be on top of that. We have to be constantly watching and seeing where the bank's policies are and how they tweaking and changing those policies. The banks want to lend out money. They want to give consumers the
Mhm.
opportunity for home ownership. No bank comes out here and says, I'm not in the business of lending. Quite the opposite. But their balance sheet and their level of risk tolerance may restrain their ability to do a specific segment of borrowing one time, but doesn't mean it's going to be like that forever. 6 months from now or a year from now, they'll review their policies or review their balance sheet, and all of a sudden they're lending, with a little bit more aggressively, if you would, or a little bit more of an exception by using other things like assets and liquidity,
Yeah.
because things have changed. But if we're on top of it, and we're always watching it, we know what's moving on. And that's why a lot of our clients, we have to move them from one lender to another in order to get them the best and most opportune options. Like to get the best options and give them the ability to maximize their savings through the journey of their mortgage. We may have to move them a couple of times because no bank will be the best option all the time.